Welcome to all of you. First of all, my very happy Diwali wishes to all of you. Been an amazing year. The month of March, no one could have predicted that on the eve of Diwali, we would see the Nifty at 12,700. And there would be such a vertical move in the markets from 8,000 to 12,600. But that is the beauty of the markets. I've had the privilege of working for 31 years in the markets, and I've had the privilege of seeing Harshad Mehta boom of 1992 and two spectacular stock market booms of 94, 95 and 2006-07. We had an extremely narrow, very big bull run in 1999, which was focused on the technology, media and telecom industry. And as most of you know, there was a very good small and mid cap boom in 2016 and 17. At the same time, we have seen spectacular market collapses also in 2001. And we have seen spectacular market collapse in 2008. And I would say March 2020 also counts as one of the spectacular market collapse in history. Because very rarely you've seen a 20 to 25% market fall in such a short span of time. So that's the beauty of markets. And it has been, I would say, investing is such a fascinatingly interesting profession. And I believe that making money in the markets is actually much more easy than what people think, provided one can control emotions. So in 2009, May, June, actually, Nimish, my CEO, and all of us, we had a lot of discussions. And what we call as a postmortem discussion of 2007, 8, 9. And that postmortem discussion was that in 2007, we had got a lot of money into infrastructure equity funds. And in 2008, when the market crashed, we got no money. And in 2009, we had a spectacular market rally. And the end result was that people did not make enough money out of the entire volatility of 2007, 8, 9. And we in the investment team were telling Nimish, our CEO, that it is so sad that if people had invested in end December 2008, they would have got such a fabulous return on their investments. But the reality was bulk of the money had come in December 2007 and in 2007. And the investors did not get a good investing experience. So what we did was we sought out to create a product. The goal of that product was very simple. Actually, the goal of the product was that we should be selling equities in 2007, buying equities in 2008, and so that the investor has a good investment experience. And when we said we have to do it, actually, we were all very reluctant whether such a product could find market acceptance. But our sales team said that we will be able to find market acceptance. And that is how the entire category called Balanced Advantage Fund came up. And we gave a very large thrust to this product. And when that thrust was given by the company to that product, starting from the top to the bottom, it actually got a momentum which was significant. But, people was wondering whether such a product can actually deliver a good investing experience and also whether we'll be able to manage it well. But there was such beautiful experience we saw. In 2013, there was something called as a taper tantrum that happened due to Ben Bernanke saying that I am going to withdraw the monetary stimulus. And that resulted in a fall in the markets in India. And in this fund, we got an opportunity to buy. In 2015, there were some serious problems in the economy in China, which got us an opportunity to buy. And we actually resulted in one of the highest equity weightages in this fund called Balanced Advantage Fund in February 2016. So we said that if we have a fund which can only buy when the market falls significantly, which will keep on buying when the market falls significantly, and keep on selling when the markets are rallying, it will be such a great product for the investors. But, the beauty was again when government came up with demonetization, market fell for 2 months. Again, we got an opportunity to buy. So in 2017 was the only year when actually markets went again and again and again. Every month it went up, and we were very worried. How can we manage to sell a product if the market goes up every month? Lo and behold, in August 2018, we had reached a very low equity weightage in this fund. And then we had the famous episode of ILFS defaulting, and then the markets crashed. Again, we got an opportunity to buy. And as you know, in 2020, we got the best opportunity because in February and March, in ICICI Prudential Balanced Advantage Fund, we got the opportunity to buy significantly when the market fell in February and March due to COVID. And that turned out to be something where you don't have to go to the investors to buy. You actually buy utilizing the cash that is there in the fund. So what we learned from 2007, 8, 9 could be implemented, and then the investor gets the benefit, because what we're doing is buying low, selling high. And what is the objective of investing? It is buying low, selling high. So in 2019, 20 January, markets are high, so we're selling when the markets are high. In 2020 March, when the markets are low, we are buying. So which is after all the objective of investing. So, and that is generally difficult to do, because emotionally to buy in March 2020 is not easy, because every day you are actually told the market will fall the next day. And imagine, in retrospect, you look at it in March 2020, no one knew that India would have 80 lakh COVID cases. And if someone had told you in March 2020 that you would have 80 lakh COVID cases, and by October 2020 you would have markets at 12,600, no one would have believed us. But the reality is, because we have a simple framework of buying low and selling high, we could gather the guts to buy in March 2020 in this category. So what I learned, and the entire company learned, and every one of us learned in the company, is that if you follow a simple strategy of buying low, selling high, you can give a good investment experience. And that is the framework that we've been using and we will continue to use. So every year, in the months before Diwali, we always think that every year we should go to our investors and create a campaign ahead of Diwali, because Diwali is a very important event in India, and it's very nice on the eve of Diwali to give a simple message to investors. So in 2018, the moment we had the problem of ILFS, we realized that it is a very good time to start SIPs. So we started a campaign called Ye Diwali SIP Wali campaign. In 2019, the sentiments due to the markets were still bad. So we said that there is no way we should stop that campaign. So we continued with the same campaign of 2018. When we looked at 2020, we realized that there is a clear case for us to have a campaign this year based on BAF, because this was a year where BAF had shown that you can actually do what any investor should be doing theoretically, buying low, selling high. And that is why we said that this year we should start a campaign called Ye Diwali SIP BAF Wali campaign. And that's what we did. Does it mean that BAF is a capital protected product? The answer is no. Does it mean that BAF will always give you positive returns? The answer is no. But at the same time, what BAF does is that it buys low and sells high. So what happens is it does something which is logical to make money. So when you do something which is logical to make money, you're normally likely to make money. And this is something which we have seen across asset classes in the period that we have all been working. So in 2012-13, people used to tell us real estate will only go up. Why was the case? Because between 2003 and 2013, for 10 successive years, real estate kept going up. And what was the view? Indian population keeps on going up, so real estate will keep on going up. And due to that, people had this view. But it's very interesting, from 2013 to 20, almost across India, real estate did not go up. Because there is this whole framework of cycles where if markets keep going up on a continuing basis, they don't need to go on forever and there can be downturns. So between 2013 and 2020, you actually didn't make any money in real estate. Similar is the case in gold. Between 2008 and 2012, you made a lot of money in gold. But between 2012 and 2018, you made no money in gold. So for almost 5-6 years, gold gave no returns. So the beauty is, even in asset classes outside equities, there are periods of time when actually you don't make money, because there are times when you get too much return. So if you look at the return on gold between 2007 and 2012, it was stupendous. So it went through a period where it didn't give you returns. And there is a big problem in the way all the industries are organized. Everyone teaches you how to buy. Very few people teach you how to sell. And this was one of the learnings that we learned by watching all bull markets. In 2007, everyone invested in infrastructure funds. In 2017, everyone invested in small caps. Did people teach how to take out money? The answer is no. So we always felt that if you want to make money in any asset class, you have to learn how to take out money. So that is the beauty of a category like Balanced Advantage Fund, particularly products in Balanced Advantage Fund, which believe that you have to sell when the equities go up and buy when equities go down, because it does something which no one teaches you. Sell. Because no one taught us that in 2012-13 real estate should be sold. No one teaches us in 2018-12 that gold should be sold. So no one teaches us that in 2017 and small cap should be sold. So the beauty about the entire financial services industry globally is it's very difficult for people to give a sell call. It is very easy for people to give a buy call. So what we did as an asset management company is we created a product where the selling happens within the product. So if you look at the ICICI Prudential Balanced Advantage Fund as a category, you'll find that we've been selling. So if you look at 2017, the whole year we've been selling equity. 2018, all the way till August, we have been selling equity. So you don't sell, the customer doesn't sell, but the fund manager sells, and the equity weightage keeps on going down. So if you look at it, in 2020 January, we were selling. So the beauty is that what the financial services industry doesn't do across the world is sell, but here within the product the selling happens, within the product the buying happens, and therefore the investors gets the opportunity to sell, and therefore the investor gets what we call a good investing experience. So when will the investor lose out? The investor can lose out if you're going to see 20% return over the next 5 years. Because I think that I don't think this is meant for a very high return market. So when the investor suppose you believe that the market is going to give you 100% return or 200% return, I think a pure equity fund can deliver a better return experience. But if you are a person who is confused on what to do and you are not clear whether at the present current high of the all-time high of the market, what to do, and you're not clear whether the market is going to give you 100% return, and you're confused, this becomes a very interesting way to play because you don't get all the upside if the market shoots up, but you don't get all the downside if the market goes down, and that is the way we think investing has to be practiced over a period of time. So, I've been a stockbroker between 94 and 2004. I'd seen a lot of people make money in 94. But by the time the Asian financial crisis happened in 1997, a lot of people had lost a lot of money in 97, 98. In 1999, I had seen a lot of people make a lot of money in IT stocks. By the time 2001 had happened, a lot of people who had made all the money, they had lost all the money they had made. So the beauty about investing is it is not how much your money you made in a bull market. It is how much money you made over a cycle. So in recent times, there were a lot of people in 2017 who said, I made huge money in small cap equity. But by the time 2019 December had come, the reality is that a lot of the profits that they had made in 2017 had kind of disappeared. So one of the learnings that I've seen is that it is not that important to make all the money, but it is more important to actually save a lot of the money that you have made. And what happens with a category like balanced advantages, you don't make all the money, but a part of the profit gets booked. So what happens is you tend to take home more of the profits that you have made, even though the profits are not full. And that is the advantage of a category like this. And one more problem that happens, I won't call it a problem. In 2017, 18 and 19, one of the messages that we had given consistently in all forums that we got a chance to talk to was the fact that people have to invest in debt. And at that point of time, interest rates were high. And when the interest rates were high, debt becomes a very interesting asset class. But right now, what has happened is that interest rates are much lower. So the kind of return that people can make in debt has come down pretty significantly at this point of time. And because the interest rates that can be made in debt has come down significantly at this point of time, so while debt plays a very good capital conservation role, the kind of returns that people could have made in debt funds over the last 3 years, it's difficult to make it now. And that is the challenge at this point of time. And that is why when you have a category like balanced advantage fund, which mixes the asset class and it has debt, equity and arbitrage, you're in better shape because the kind of returns that people can make in debt is no longer what can be made in 2017, 18, 19. And it's very critical for people to know that the last 3 years return in many of the debt funds is not sustainable because the last 3 years was made when interest rate cycle was downward. And if I had to take a call on the next 3 years, I do not think that the next 3 years the interest rates are going to go down. It can either go stay down or it can go up. And if interest rates go up, I don't think that we are in a situation where you can make big returns out of debt funds, which also means that a category which mixes all the asset classes may be a more interesting category, which is the reason we started this campaign this year. On the whole, we want everyone to enjoy their work and utilize mutual funds to make money in the long run. We want a product where people should invest and buy it, shut it, forget it kind of product. We are not interested in having products where people have to monitor every day what they are doing with it. We are not interested in a product which maximizes all the return but require daily monitoring. We are comfortable in offering products where the upside is not full but monitoring required is lower, and that is what our Balanced Advantage Fund is all about. And that is the reason why we have followed this in this year's campaign. And that is the way it is. So where are we in the markets? I believe that this year, the entire success of where the market is this year has to go to the global central banks led by the Fed. The Federal Reserve brought down interest rates to zero and basically guaranteed everything on earth and pumped so much money into the markets that we had this relentless stock market rally across the world. Now what has happened is a lot of money has been pumped in by the global central banks. And all those global central bank money has resulted in this massive global equity boom. As long as the money stays within the equity markets, it is extremely good for investors. The day that money leaves the equity market and goes into prices, I mean, suppose it goes into products like oil, goes into products like food in other parts of the world, suppose it goes into rents, it goes into other things, then you will have inflation. And once it goes into inflation, then the global central banks will have to tighten liquidity, and then the markets can actually will see withdrawal of liquidity. Once you see that withdrawal of liquidity, markets can fall. And when that will happen, neither ICICI mutual fund nor does any mutual fund in any emerging market know when it will happen. Will it happen in 1 year? Whether it will happen in 3 years, whether it will happen in 5 years, no one knows. Because at this point of time, one has to remember that valuations are not cheap in any of the quality sectors. It is cheap only in the sectors like special situations, dividend and value, dividend yield and value. So if you're looking for cheaper areas of the market, it is only dividend yield, value and special situations. These are the only cheap sectors at this point of time in the market. Other areas are really expensive at this point of time, and they have been pulled up by basically global central banks pumping in a lot of money in the market. So in my opinion, till the time price inflation comes, we are safe. The day price inflation comes in the global economies like US, that time is when the day of reckoning comes, but I do not know when that day of reckoning will come. And the day that reckoning comes, I think we can have a setback. But till that point of time, my view is that cheaper areas of the market will become much more costly, because today you have a situation where dividend yield is higher in many Indian companies than the interest rate at which they borrow. So there can be a good rally in many of the dividend yield stocks. There can be a good rally in many of the value stocks and many value sectors like telecom, power, construction, metals. Many of them have not delivered returns for more than 12 years. Some of the sectors like banking have seen a rally recently, but they have not rallied if you look at the last 10, 12 years. So many of the cheaper sectors in the economy can rally from here as long as the global liquidity continues to increase based on the global central banks. And that is the kind of situation we are in. But as far as debt is concerned, I think the primary rally is over. The near term looks good in debt. And I believe that all the investments people have made in the period prior to September 2019, 2020, there is a case to stay invested. But people who are investing from now should invest for the short run. If you're investing for the long run, I certainly believe that equities on the value side, like value side and dividend yield and special situation are better. Obviously, equity is a much more riskier asset class than debt. But debt in the long run on new investments don't look as attractive as they looked in 2017, 18, 19. But I believe all the investments that people have made in 2017, 18, 19 should logically be continued, because even from a taxation point of view, the way the indexation model works, I think it makes sense for all the older investments to stay permanently invested, because you get the benefit of indexation as you stay longer and longer. As long as the current tax law stays, it makes sense for all the older investments to stay. This is subject to current tax law stay. But on new investments in debt, it makes sense to have a shorter term view, because because I do not think in the long run interest rates will stay as low as what they are today. And that is the kind of situation we are in. So I want to clearly communicate that I think there is a massive opportunity for all the people who want to enjoy their life and do their other work, and want to think long term with a buy it, shut it, forget it kind of model, to actually choose our campaign, Ye Wali Diwali, Back Wali Diwali, and invest. You will not get the entire upside. This is not a capital protected product, but I think this is the kind of best campaign that one can do, because this is a way to get best risk adjusted returns for long term investors at this point of time. Because it does something which most products don't do, because it buys equity, it sells equity when they go up, it buys again equity when they go down, it sells equity again when they go up, it buys equity again when they go down. So it becomes a product which you can hold for long term, and of course it will underperform a pure equity fund in any big bull market. But I think for most investors, optimizing the exact optimum is not as important as moderating the decline. That is what I have learned from my 31 years of working. And this is the learning that ICICI Prudential Mutual Fund team also has had over looking at lot of investors over the long run. And that is what I wanted to convey. Let me all wish all of you a very happy Diwali. I think in the month of March and April, we conducted a massive outreach explaining to everyone that they should stay invested. All of you who stayed invested in March, April, May in both equity and debt funds, I must congratulate all of you. We did as deep an outreach as was possible for all of us. And I must congratulate all of you for staying invested at that point of time, because all the people who stayed invested during those outreaches have benefited very significantly. And thank you all for staying invested. And that's what I wanted to convey. Wishing all of you a very happy Diwali, and following that a very happy Christmas and New Year. Thank you all, and look forward to many, many prosperous years of investing ahead, and looking forward to many, many years of investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.